Also, what is this? What is this? Is this payout or retention? Those are things you have to be careful about. No, still there is a mistake. Nikunjit? No. No, there is still a mistake. Ah, sorry. I think, Nikunjit, you are giving me the price of the growth company, not the PVGO. So I need the PVGO. So based on that, Nimasha, your percentage seems wrong, but your PVGO answer is correct. Yesterday and today, there is no difference in what we're doing. The same sum, only one thing has changed, but we're working out the same sum. No, Rashmi. Remember, what is this? Is this payout or retention? I have to believe, I think that must be where the error is coming from. Just double check that. So is this payout or retention? Is that payout or retention? No, Zarina. Retention, yes. Yes, correct. Retain. So you retain 60%, that means you pay out 40%, right? So you pay out 40, retain 60. That's how much you keep. And you reinvest these in projects generating an ROE of 10. So the ROE is 10. I mean, what that means is essentially any money that you keep, you're using towards generating earnings, right? So any money that you keep, that's what we showed yesterday. You invest towards generating earnings. So that's what we mean by reinvest 60% of its earnings in projects generating ROE of 10%. And 40% it is paying out as dividends, right? So that the dividend of 2 rupees represents a payout ratio of 40%, and this is D1. So if this is D1, and payout is 40%, how much is E1? How much is E1? 5, yes. D1 is 2 rupees, payout is 40%. So 2 divided by 40%, E1 is 5 rupees. Shareholders' required rate of return is 15%. What is PVGO? So for PVGO, I need to know the price of the no growth company. Price of the no growth company is equals to E1 divided by R, which is 5 rupees divided by 15%. So this is what yesterday also you all got 33.33. Price the growth company, we can use the constant growth equation because it says it plans to carry this out indefinitely. It plans to keep on reinvesting 60% of its earnings in 10% generating projects, meaning indefinitely your company is going to grow at the same rate, right? So growth is constant. So what is the growth rate? Growth rate is your ROE into how much you keep inside. So ROE is 10. You keep inside 60. So your growth rate is 6. So what is your price of a constant dividend company? D1 divided by R minus G. So that's 2 divided by R is 15%, G is 6%. So 2 divided by 9%. 2 divided by 9%, is that 22.22? Yeah, thank you. Okay. So my mistake, Vikumjit, I think. Okay. So what is PVGO? PVGO is the difference between the growth company and the no-growth company, which is 11.11 negative, or minus 50% when you take into account 11.11. So, Nimasha, that's correct. 11.11 divided by the price of the company, which is 22.22. Okay. Negative 50%. Negative 50%. What does this mean? What does this mean? Anybody? The company is growing at a rate of 6%, but I am not willing to pay for it. I am giving a negative, I am giving a negative premium of 11 rupees for this company. I only value this company at 22 rupees, which is lower than if the company was not growing. If the company was not growing, it's still worth 33 rupees. Why is that? Let me put all that information. Do you see that this is the same as this company? It's the same details written in a different way. Here it says reinvest 60%. Here it says payout of 40%. Right? Cost of equity 15%. Annual dividend 2 rupees next year. Here it says end of year. So if you put the 3 examples side by side, what do we see? So the only thing that differed between the 3 examples was that this was you had a 20% ROE company, a 15% ROE company, and a 10% ROE company. payout of all three companies were 40%. Which implied retention of all three companies was 60%. The growth in the three companies were different. Base 20 into 60, here the growth rate was 12%. 15 into 60, here the growth rate was, how much was it? 9%. And 10 into 60, here the growth rate was 6%. Price of the no growth company of all three were the same because earnings were the same. This D1 was 2 rupees. E1 was 5 rupees. Therefore, the price of the no growth company was 33.33 rupees for all three. Cost of equity was 15%. Price of the growth company was 66.66, 33.33, and this one we got 22.22. And PVGO we got 33.33, 0, and negative 11.1. Same company, three different scenarios. What are the differences between these three scenarios? Why is PVGO negative in the last scenario? Yeah. Reinvestment return is the lowest, meaning what? ROE is the lowest in the last one? Yes. How does that make, you're right. How does that make the PVGO negative? Why is the PVGO negative here? What are you going to compare your ROE against? Okay. Yes, sorry, I didn't see that. ROE versus, you look at your K. So what do you see here? What does KE mean? Do you see here when ROE is higher than K is 15%, ROE is 20%. PVGO is positive. When K is equal to ROE, PVGO is 0. And when K is higher than ROE, PBT is negative. What does this mean? What does this mean?
Companies the loans and everything is we have to pay is much more higher than the return that we get out of the business.
Not the loans, but the return that the investors want, right? What is your KE? What does it mean?
It's a combination of capital, right? It's equity plus the whatever the borrowings we have.
So it's not a combination of the capital. KE is the cost of equity. You're talking about the weighted average cost of capital. K is not the weighted average cost of capital. You have cost of debt and cost of equity, and the combination of that capital is the weighted average cost of capital. But here we are talking about your required rate of return on equity. So this is what the equity holders want, the shareholders of the company. So if the shareholders are investing in the company expecting a return of 15%, like you said, if the company is only giving you a return of 10%, then what is the best alternative for the company? Is it worthwhile for the company to keep its dividend inside? When shareholders are investing, they want a return of 15%, right? They are investing in a company. If they're investing in a company that gives a return of 10%, is it worthwhile for the company to keep, or is it worthwhile for the shareholders that the company keep the dividends inside it? Technically, not. Because for the shareholders, they can go and invest in another company that will give them at least a 15% return, right? So for them, it's if you look at the three companies, A, B, and C, let's call them A, B, and C. The three scenarios are the three companies, right? Everything is the same in the three companies except for the fact that shareholders want 15% return from all three companies, but the ROEs that the companies are generating is different, right? In a company of 20%, in a company where the ROE is 20%, that means the company is growing at a rate that sustains a 20% return to its shareholders inside the company, right? Inside the company is growing at a rate that's giving a 20% return on its equity. What is equity? To its shareholders. So then, when I put money in the company might as well keep that money because the company is growing and that growth is higher than the return that I want. I want a 15% return, and this company is growing at a better return, a better rate. So the company might as well not pay me dividends, but reinvest it inside the company and utilize it for growth. When the company is giving me 15% return, ROE, and I want 15% return, I won't pay a premium for additional growth in the company. I won't pay a premium for additional growth, whether it keeps the dividends inside the company or take it outside doesn't make a big difference, right? Or take it outside, meaning I get the dividends to my hands, doesn't make a big difference. So I won't pay a premium, additional premium for growth of the company because I want 15%. Company is giving me 15%. On the other hand, when I want 15% and the company is only returning 10%, it's better that the company actually pays out more dividends. Because if it keeps the money inside, it's going to invest in subpar projects which only generates a return of 10%. Right? If I get the dividends to my hand, I can go and invest in another company that gives me 15%. So it's better that the company pays me the dividends. Okay. The company might have a different idea, but on my hand, I will not pay a premium to a company that's generating a 10% ROE. Okay. I will actually, it will be a negative premium, meaning I will actually buy this company at a discount or not pay more than what I pay for no growth in that company if it paid out all its dividends, right? So I actually give a discount to this company because I think that this company should be paying out more dividends and not reinvesting it inside the company. So the present value of growth opportunities kind of gives me an idea for one thing. How much is the additional amount I'm paying for growth? What is the premium I should pay for growth? Because this is the intrinsic value, this is not the actual market price. This is how much I should pay for growth. And if the company doesn't pay out dividends and keeps it inside, then they had better use it in projects that grows more than 15%, that gives returns more than 15%. If it doesn't, then I won't pay a premium for this company for growth. I would much rather have the dividends to my hands. That's what this is showing. Any questions? Okay. So from this, let's move on to what we call justified P ratio. I'm going to go away from this slide. Justified P ratio. Okay. Before we come to justified P ratio, just an understanding. What do you mean by P ratio or price earnings ratio? Price earnings ratio. Well, I've heard of price earnings ratio, right? Or PE ratio. What is PE? Market price. Market price is not PE. What is PE? That's yes. Yes. P is how many price divided by the earnings or the EPS of the company, right? Or in other words, the market capitalization, the total value of the company, if I take it from total value perspective, divided by my net income or profitability of the company. Sorry, what's happening? Net income or profitability of the company, right? So per share basis, this is P, price as a percentage of earnings. On a total basis, total share basis, this is P, the total market capitalization of the company divided by the total earnings of the company or net income of the company, right? It kind of gives me, like you said, it kind of gives me a perspective of how many times of my EPS or earnings am I paying for this company. When I say P is 2, I'm saying I'm paying twice the earnings of this company to buy this share. Okay. Because I look at the share price is 20. This company is making an EPS of 10. Therefore, P is 2. So when P is 2, I'm paying 2 times the earnings of this company to buy this share. Right? When I say P is 10, I'm paying 10 times the earnings of this company to buy this share. Or P is 20, I'm paying 20 times the earnings of this company to buy this share. Why do I pay 20 times the current earnings to buy this share? Because I'm looking at the growth potential. Right? Now, I'm looking at the growth potential and I'm saying this company is going to grow so much that I am willing to pay 20 times of today's earnings to buy this share. Today's earnings to buy this share. Now, although I say today's earnings, technically, if you're looking at analyzing buying a company correctly, I shouldn't be looking at today's earnings. P correctly should be today's price as a percentage of next year's earnings, what I expect to happen, right? That should be what PE is. So PE ratio, obviously, investors can analyze in different ways. You can look at today's price as a percentage of today's earnings. Or sometimes we look at today's earnings means anyway, it's historical earnings, right? So the trailing 12 months earnings or last year's earnings, that's what we mean by PE. But correctly, if we are doing an analysis of PE, and especially when we want to value a company based on PE, we shouldn't be taking current earnings. We should be looking at future earnings, right? So PE, correctly, we should be looking at what is the PE ratio? How much am I paying? How many times of future earnings am I paying? So PE ratio of 2 times, 3 times, 4 times. PE ratio is always defined in times. It's not a percentage, it is the number of times. 20 times future earnings, 30 times future earnings, 10 times future earnings. So I can use P ratio, and we'll come to that in a minute. Not a minute, but we'll come to that today. I can use a P ratio to actually value a company based on my multiples of what I think this company is worth, how much am I willing to pay, how many times its future earnings I'm willing to pay. I can figure out what is the price that I'm willing to pay for this company. But right now, what we're going to look at is what we call justified PE. Justified PE, right? Justified PE means, can you enter this into your notes, please? Justified PE ratio. What I've put in red sometimes are things that I've changed. So just double check in your notes if it's there or not, right? Justified P ratio. What the justified P ratio talks about is the fundamental PE ratio. How many times earnings should I pay for this company? That's my justified P, right? Actual P in the market is how much earning, how many times of earnings I am actually paying for this company. But when I want to look at the intrinsic value of this company, another way to look at it is to figure out what is the justified PE ratio. And the justified PE ratio actually comes from, it's derived from the Gordon growth model, right? The Gordon growth model. So the easiest justified PE ratio that we can derive is from the no growth model. Yeah. Sorry, I'm not sure what happened, but my computer shut off suddenly. Not certain what exactly happened there. Right. So, wait. Justified P ratio. So, on a no growth model, we know that in a no growth model, the price of a share today is what? Anyway, it's the dividends divided by K. Let's call it our required rate of return. Or because the dividends to get no growth, the dividends are entirely paid out, it's the earnings divided by R, right? So if I just take the earnings down, divide both sides by the earnings, very simply, I get the PE ratio. And what does the PE ratio say? The PE ratio of a company that is not growing, right, should be 1 over R. That's it. It's very easy. PE ratio of a company that is not growing should be 1 over R. This is what we call the justified PE ratio. It means from your intrinsic value, it gives you what the PE ratio should be, not what it actually is, because what it actually is based on market prices. But the justified PE ratio is based on your intrinsic value of the company. Excuse me. Based on your intrinsic value of the company, right? So here it says, if the company is not growing, the number of times that you pay for the company is simply 1 over how much you want as a return, your required rate of return, right? So, for example, if your required rate of return is 20%, you should be paying 5 times for the company. If your required rate of return is 20%, then you can go up as high as 5 times your current next year's earnings, future earnings, right? That's what your PE ratio is telling you. For a no growth company, it depends just on what is your required rate of return. If your required rate of return is 10%, then you can pay 10 times next year's earnings to buy this company. If your PE ratio is 15%, then you can pay what? 6.5 times or whatever to buy this company, right? So that's what your PE ratio is telling. Any questions here? Justified PE ratio. So the same way, I can find the justified PE ratio for the constant growth model. In the constant growth model, again, we start from the fact that what is the price? Price is next year's dividends divided by R minus G. Right? Next year's dividends, I can rewrite. What is next year's dividends? It's my next year's earnings into how much I pay out as dividends, right? 1 minus the retention rate, because we know that retention rate is defined by B, 1 minus the retention rate or the payout ratio, right? Divided by R minus G. G is rewritten just for convenience as ROE into B. And that's what is shown here. So what is the PE ratio? You bring E to this side, you divide both sides by E. It's 1 minus B divided by R minus G, where G is rewritten as ROE into B. Why do I rewrite it as ROE into B? Because now I want to take the justified PE ratio and figure out what are the things that impact my price earnings ratio. That's why I write the full equation, ROE into B. Okay. Any questions? Okay, so based on this, let's first do a question. Try this. Just change this to justified P ratio. Justified P ratio. Let me change. I didn't see that. Mhm. Mm. Is your growth right? I just check on your growth, Niraj. Nimash, your growth percentage is not correct. And Niraj, when your growth changes, your other two answers will also probably change. Yep. And based on the PE ratio, what is the maximum price you should pay? 55? No. Growth is not correct. Yes, growth is correct. So the maximum price you should pay based on PE, do it both ways, based on PE and based on your Gordon growth model. Yes, Rashmi, correct. So a couple of you are giving me like the growth rate and the justified PE, but what happens to the maximum price you should pay to purchase the share based on the PE? So growth is pretty easy. Oops, sorry. Growth is simply ROE into P. ROE is 10%. B is you retain 50 cents of 2 rupees. So it's 25%. Right? Sorry, so my mistake. Is growth 3% or 2.5%?
Madam, ROE is 12%.
Okay. Right. Okay. Thank you. 12% into 25% is 3%. That's growth. Nimasha, correct. Then PE. PE, according to the justified PE ratio, is equals to 1 minus B divided by R minus G. So 1 minus B is my payout. Okay. Payout is 75% divided by R. R is, where is R? Cost of equity is 10%. Minus G is 3%. So I see you all are getting P ratio of 10.714 times. Right? So that's the answer, 10.714 times. Based on this answer, what is the maximum price you should pay to buy this share? Do you see the price? The price that you should pay to buy this share is equals to the PE ratio into next year's earnings. Because then these two terms cancel out and you're left with the price. So the price that you pay to buy the share is the PE ratio into next year's earnings. Next year's. Now you've seen how it's derived, right? We saw how it's derived. So you understand why it is next year's earnings. Okay. So the PE ratio is 10.714. Earnings are 2. So the maximum price that I'm willing to pay to buy the share is 21.428. 21.428. Can I get the same answer using the dividend discount model? Yes. If I use the dividend discount model, the dividend discount model says price is equals to D1 divided by R minus G. What is D1? D1 is 1.5 divided by R minus G. 1.5 divided by 0.07. Check the answer. You should be getting 21.428. Okay. Any questions? Because it has to, you have to get the same answer because the justified P is derived from the dividend growth model. So because of this, you have to get the same answer. Any questions here? So always, when we use the PE ratio, what we're trying to do is, whatever PE ratio that we use, what we're trying to do is figure out how many times of earnings are we going to pay to buy this company. Okay? Now, how many times of earnings are we going to pay to buy this company? What earnings? Not last year's earnings, not current earnings, next year's earnings, future earnings. It's important, right? It's future earnings. How many times of future earnings am I willing to pay to buy this company? And your justified P ratio tells you, based on your intrinsic value, what is the maximum price you should pay to buy this company. By the next part. Don't worry about PEG ratio, PEG ratio right now. Just do the rest. Shouldn't take this much time. It's a very easy question. Part two, what's the problem? What do you mean by plowback rate? Is that the question? Then you all should be asking me. What do you mean by plowback rate? Plowback, what does that mean? Retention rate, correct. Plowback, how much you hold back, right? How much you plow back, hold back, or retain. So plowback rate is your retention rate. Yes, 55. 55 looks okay. And price. Oh, great. Sorry, 55, just check your growth again. Remember, are you using the correct ratio for growth? Plowback or payout? Which ratio have you used? DPS is correct, but your growth and price PE are not because your growth is wrong. Nimasha correct. Looks okay. What is your price? So if your retention ratio is, yes, retention ratio is 40%, that implies your payout is 60%. Right. So if your earnings are 2 rupees, then that implies that your dividends are going to be 60% of 2 rupees, 1.2. What's the firm's expected dividends? Growth rate. Growth rate is ROE into B. How much you keep back or plow back, which is 12% into 40%, which is 4.8% growth rate. Let's look at PE first. What is PE? PE is 1 minus B, that means the payout, so it's 60%, divided by R, 10%, minus G, 4.8%, comes to apparently 11.538 times. If there is a mistake, please let me know. Based on that, price is what? Price is 11.538 times earnings of next year, 2, which comes to 23.076. Those are things that we know. Those are things that you all should be able to quickly find because that part is easy, right? There is another concept called PEG ratio. PEG, right? PEG means price earnings to growth. That's what it means, price earnings to growth, right? Because there is this common misconception. Well, it's not a misconception per se. It talks about markets being fairly priced or not, right? But there is this common belief, let's say, in the market that high P's are not good, low P's are good, right? We're just going to talk about whether that is true or not. But high P's are generally perceived to be not good. 20 times P is not good. Kind of showing that your stocks are overvalued versus 3 times P's are good or 5 times P's are good, showing that your stocks are undervalued, right? So really speaking, these should be checked against the justified P. You're just putting numbers and you're saying 20 is not good and 3 is good. But commonly in the market, we always talk about how higher the PE, it's not so great because it implies that the company is overvalued, and lower the PE, it's good because it implies the company is undervalued, right? So when we take the market PE, what is the market PE? The PE of the share market? Market PE ratio is the market capitalization of all the companies in the market divided by the earnings of all the companies in the market. Okay. Do you all remember what the market PE is right now in the stock market? Explain this. I suddenly forgot. Yes. Our stock market P is 9.73 right now, right? Of course, this is based on historicals. It is not based on forwards, because the stock market doesn't look at forward earnings, right? It doesn't calculate forward earnings. It's based on historical earnings, and based on the historical earnings or trailing earnings, it's saying that the stock market PE is 9.73. Now, stock market PEs have been high as 20 times in Sri Lanka, right? So 9.73 in the market seems like a good PE. This is generally how we would perceive it, right? Because we say lower the PE, better. Lower the PE, better. Because it implies it's undervalued. But really, it does not. Okay? Because the PE, the actual PE in the market, of course, you should make an adjustment to make it forward earnings, right? PE is actually based on actual market prices, right? So this should be compared against the justified PE. You can't just say high PEs are bad and low PEs are good. You have to compare it against the justified PE, right? Another way to look at it is to look at the PEG. That's the price earnings ratio as a percentage of growth. Percentage of growth. So, for example, we call it the PEG ratio. PEG ratio. So, for example, now we are saying our Sri Lankan market is PE is 9.7 times, right? 9.73. If we are expecting the country to grow, not the country, the share market, in the sense the earnings of the share market, okay, and assume that this is a forward PE, because it's actually not. You have to make an adjustment to make it a forward PE. But assuming it is a forward PE, if I'm expecting the share market, earnings, if I'm expecting earnings of the companies inside the share market to grow next year by 20%, if I'm expecting growth to be 20%, then in context, this ratio looks good. This ratio looks good. So, we shouldn't be putting it in when we put PEGs, we should be putting it in the same, denominations, right? So we just use 20. If my earnings are expected to be 20, then the PEG ratio is low. If the PEG ratio is low, then that's good. Because what we're saying is, as a percentage of the growth that we're expecting, P is cheap, right? So PEG of 9.7 divided by 20. Or if we are expecting growth to be 10% of all the companies in the market next year, then PEG would be 9.7 divided by 10. Or if we're expecting growth to be 5% only in the market next year, then it will be 9.7 divided by 5. So PEG ratio, let's just make this PE 10 just for ease of calculations. So let's assume Sri Lankan market PE is 10. If Sri Lankan market PE is 10, right? And I'm assuming next year it's going to grow at my earnings of the companies are going to grow at 5%, then my PEG ratio is 2 times, right? If it's going to grow at 10%, my PEG ratio is 1. And at 20%, my PEG ratio is 0.5. Generally, we say if the PEG ratio is below 1, rule of thumb, if the PEG ratio is below 1, that's good. That's good in the sense that justifies the company because the company is going to grow. Okay. So based on the company's growth, how your PE or your PEG ratio will give you an idea of actually whether the market is overvalued or undervalued. actually whether the market is overvalued or undervalued. Say, for example, right now in Sri Lanka, we had P's of 20 times. We've had P's of 20 times. If next year I think the market is going to go up by 30%, P's of 20 is not expensive. People believe P's of 20s are expensive, 30s are expensive, right? People prefer lower PEs because they think that is indicating an undervalued market, a cheap market. It's intuitive, right? Because PE is how many times the earnings I'm paying, right? For my price, how many times the earnings that I'm paying. So lower the PE, lower the price that I'm paying for my earnings, higher the PE, higher the price that I'm paying for my earnings, number of times earnings, right? So it is intuitive, but it is not actually correct necessarily. Because for one thing, it's okay to pay higher price for your earnings if you think there is growth, if there is potential for growth. So it really depends on, is this company worth it? That is why you should compare it with your justified P. The market or the company's actual P's, you should compare with your justified P to figure out actually if it is expensive or cheap. Any questions? Very quiet class today. So what is my PEG in this example? My PE is 11.538. My growth is 4.8. So what is PEG? PEG? Sorry, 2.403. This is kind of a high PEG, but this is based on your justified PE, right? Your PEG makes better sense when you try to analyze it against your actual PEs, your actual PEs versus your justified PE. Because when you look at your justified PE, all of the thought process of what we say, higher the PE is bad, lower the PE is good, because high PEs show you overvalued companies and low PEs show you undervalued companies, we see is not necessarily true. So if you try to analyze the justified PE, look at the components of the justified PE ratio. Okay. So can somebody tell me, how does PE change with ROE? How does PE change with ROE? Yes, correct. Higher the ROE, higher the PE, right? Higher PE. Why? When ROEs go up, this entire term increases. When that entire term increases, this entire term decreases. When the denominator decreases, price earnings go up. So PE is actually positively correlated to ROE. Right? PE is positively correlated to ROE. What about risk? What about cost of equity? There is a negative relationship, correct. So with cost of equity, you will see that higher the cost of equity, this term goes up. When this term goes up, this term goes up, the denominator goes up. When the denominator goes up, PE comes down. So there is a relative relationship between PE and cost of equity. Okay, oops. There's a negative relationship between PE and cost of equity. Okay. So if there is a negative relationship between PE and cost of equity, what is the relationship between cost of equity and risk, do you think? What is the relationship between cost of equity and risk? Higher the riskiness of the company? Sorry? Higher the riskiness of the company? P is actually higher, right? Because what is cost of equity? Remember, cost of equity is the return that you want for the risk that you're taking. So higher the risk, higher the return that you want. Higher the risk, higher the return that you want. So there's a positive relationship between cost of equity and risk. So if riskiness increases, cost of equity increases, PE decreases, right? So PE has a negative relationship with risk. It has a negative relationship with risk. What about B? What about B? How does the relationship for PE work with B? The retention ratio. Lower. Lower, lower. When risk is higher, cost of equity is higher, PE is lower. I said cost of equity is higher. When risk is higher, cost of equity is higher. PE is lower. You're right. Okay, what is the relationship with B? Is it positive? Now, B is there in two places here. Let's look at the numerator. When B goes up in the numerator, what happens? What's a good color to use? When B goes up in the numerator, what happens? This whole term reduces, right? So if the numerator reduces, PE reduces. But in the denominator, what happens? I'm running out of colors that are similar to each other. In the denominator, when B goes up, when B goes up, what happens? When B goes up, this whole term goes up. When that whole term goes up, the denominator comes down. When the denominator comes down, PE actually goes up. Right? So it's a bit of a problem to figure out how I retain my dividends impact PE. Okay. Impact PE or my price. In other words, my price. So, for example, again, when B goes up in the denominator, what happens? This entire term goes up. That means the denominator comes down. That means my PE goes up, right? So because of B, my PE goes both ways, depending. My PE goes both ways. So with B, it's a bit more tricky. It's a bit more tricky. Yeah. How does B impact PE? That's not, that depends on whether the numerator dominates or the denominator dominates. Does the growth dominate or the retention dominate? That's what it depends on, right? So that's something that you have to, that we have to figure out. So let's look at it. Is it okay? Can I move out of this slide? Any questions? So here, one thing that I forgot to say is, do you see that when ROE increases, PE increases? When riskiness increases, PE decreases. We'll see what happens with retention, but do you see, is ROE increasing a good thing? Of a company, is ROE increasing a good thing? Yes or no? Of a company, ROE increases are good or bad? Yeah, yes. ROE increases are good, right? So in a company, we would want ROEs to go up because the company is more efficient. It shows that the company is being more efficient. It's utilizing its equity better. So ROE increases are good. So then actually, I should be willing to pay higher for the company. That's what it's showing. Right? So that's why we say PE being high is not necessarily a bad thing. PE being high is not necessarily a bad thing. Although I'm paying more times my earnings, it doesn't necessarily mean that the company is expensive. That's why you can't just unilaterally say high PEs are bad and low PEs are good. You have to check it against your justified PE, right? You have to check it against your intrinsic value. Just to unilaterally say high PEs are bad and low PEs are good is actually wrong. It is intuitive, but it is not correct, right? It is intuitive because PE is the number of times of earnings that you're paying to buy a share. So if I'm paying 20 times my earnings, that seems expensive, right? If I'm paying 2 times my earnings, that looks cheap. But I might be paying 2 times my earnings because the share is very risky. With higher the risk, lower the PE, lower will be the PE, right? Higher the risk, lower the PE. So my justified PE is lower. So actually, high risk shares mean that the PE should be low. I shouldn't pay that many times my earnings to buy the share because I'm taking on higher risk. So I can't just look at a share and say, the PE is 2, that's really cheap. This is a share I should buy. You should consider the riskiness. You should consider the ROE and you should consider the dividend payout. Only thing is, how does the dividend payout work? Let's look at it. Okay. So remember, according to justified PE, actually high PEs are good, Low P's are bad because high P's imply high ROEs. Low P's imply high risk, right? But in the market, we think high P's are bad, low P's are good. It should be correctly checked against your justified P. Questions? Okay. So let's look at B. Let's try this question. So in this question, you have to fill out all of these numbers, right? So you have to fill out this table, which is 24 numbers. So let's not fill out 24 numbers, but let's do a few. So can you do this, which implies this, right? That's the growth rate and the PE ratio for 0 plowback and 10% ROE. Then let's again do this because 0% 0 ROE is a very easy. It's a no growth company. Then let's do this, this, and this, which that means you'll have to, well, doing one would mean that immediately you can do the next part, right? Try that. For different scenarios, what is your growth rate? And based on that, what is your PE ratio? So your required rate of return, which is the only other thing you need, is 12%. So plowback ratio is the retention ratio. If retention ratio is 0, what is the growth? If retention is 0, what is the growth? 0, correct. Right. So if retention is 0, growth is 0. Thank you. So thank you, Nimasha. Yes, completed the total table for growth. So if plowback ratio is 25% into ROE of 10, it's 2.5, 5, 7.5. 12 into 25%, 3, 6, 9. 14 into 25%, 3.5, 7, 10.5. Thank you. That's the growth rates. So now it makes it easy for you all to complete the rest. So if growth is 0, what is the PE ratio? Remember, for growth equals 0, the justified PE was 1 over R, right? So if the growth is 0, what is the P ratio? 8.333. Okay. Oh, sorry. Is it 8.333? Isn't it 1 over? Yes, it's 1 over R. You're correct. You're correct. Sorry. Thank you, Nimasha, 28. So 1 over R. R is 12%. So 1 over 12%. P ratio is 8.33. And do you see that doesn't change according to ROE? It does not change, right? Because growth is 0. So in a 0 growth company, it only depends on your cost of equity. Cost of equity, right? So that remains at 8.33. What are the at 12% ROE and plowback of 25%? How much is the PE? Or is that also 8.33? So at 25%, it's a growing company. Growth rate is 3. And what is the PE ratio? PE ratio is 1 minus B, the plowback, divided by R minus G. So R is 12. G keeps on changing, 369. And 1 minus B is 25%, 50%, 75%. So if the plowback is 25, then this is 75. So 0.75 divided by 12 minus 3. Right. Does that come to 8.33? If it's wrong, please let me know. And this one, 50% plowback. %50 plowback means 50% paid out divided by 12% minus 6%. Right? So 0.5 divided by 0.06. Okay. So thank you, Nimasha. So these are the answers she's got. Okay. So those are the answers that we've got. Let's check. Perfect. Right. Thank you. So what do you see here? What do you see? What are the learnings from this? You have a company, and what we're saying is this company has this company has a required rate of return of 12%. So investors to invest in this company is asking for 12% returns. Right. This company might have ROE of 10, 12, or 14 and might pay out 100%, 75%, 50%, or 25% of its dividends. Right? In such a case, what are the trends that you see in PE ratio? In PE ratio, what are we trying to find? We're trying to find how PE changes with your retention. What do you see? What do you see? Correct? Yes. Good. Yes. So that's something that's important to understand here. Do you see that always growth increases the more you keep back inside the company? Right? Growth increases. the company, the more you keep it, see, you keep back nothing. You keep back 25%, 50%, 75%. What do you see? The company's growth keeps on increasing. When you go towards this side, as you move along this, you see that growth keeps on increasing. Growth can keep on increasing, but PE, not necessarily. Not necessarily. Right? When your ROE is 10% and this is not the company's required rate of return. When we say the company's, the investor wants this, right? When you want a required rate of return of 12% for investing in the company, and the company is only giving you a 10% ROE, you're not getting what you want. You want a 12% required rate of return, right? You want 12% return. Company is only generating 10% on its cost of capital, not cost of capital is the wrong word, on its equity, on its funds, right? So if it's generating only 10% on its funds, the more you retain inside the company, the more the shareholders hate it, right? They don't want that. They want you to pay out dividends. So they'll give you a premium for paying out more dividends versus less. So if you hold back more dividends, if you don't pay it out, your share price can actually come down. Versus vice versa, do you see that when the company generates internally more than what the shareholders want, shareholders actually pay a premium. They're willing to pay a premium. They're willing to pay 16 times the earnings to buy this share. Versus the more dividends that you give out, they're not happy. They want you to keep the money and generate more value for them. Because shareholders get value from two ways. One is by paying out dividends. The other is by capital appreciation of the share price, right? Capital appreciation of the share price. So they would rather you keep the dividends and earn better profits and improve, translate to better share price than pay it out. So as long as ROE exceeds your required rate of return, right? PE increases with the higher retention, right? As long as ROE exceeds. If not, it does not. This relationship does not hold. So remember we spoke about PE increases with ROE. We don't even need to think about it, right? PE increases with ROE. PE decreases with risk or required rate of return. Okay. Whereas the risk is higher. P is inversely proportional to risk. P increases with plowback if ROE is greater than shareholders' required rate of return. Otherwise, it does not. So, for the amount that you retain and the amount that you pay out, there is a specific conditionality. Otherwise, we know that P is higher the ROE. We know that P is lower, higher the risk. Right? Higher the risk, lower the PE. Higher the required rate of return, lower the PE. Higher the ROE, higher the PE. Higher the retention of money, higher the PE only if your ROE of the company is greater than shareholders' required rate of return. Any questions? Understood? So one thing that you should understand here is how PE is not necessarily expensive just because it's high. It doesn't mean that it's expensive. It doesn't mean that the share is overvalued, right? It could mean that, but you have to check it against justified PE without just unilaterally believing that high PEs are expensive shares that are overvalued and low PEs are cheap shares that are undervalued. You can't believe that. That's what the market, that's what a lot of people believe, right? But if you have a low PE, check. Is it low because risk is high? Or is it low because the company is not paying a lot of dividends and the ROE is low, right? And same way, so then does it justify being low? That's what I'm saying, right? If the PE is high, check. Is it high because it's overvalued or because its ROEs are high and the company is retaining and generating more returns? So those are things that you need to check before unilaterally thinking high P's are bad and low P's are good. Okay. Because justified P says exactly the opposite. Questions? Okay. So we finish dividend discount models. Oh, sorry. One more thing. Small thing. This PE ratio we can rewrite for PVGO also, right? Remember your PVGO? This is PVGO. Price today is equals to the value of the no growth company plus the value of the growth company, right? So if I take out, divide both sides by E, I get something like this, right? I can also take out 1 over K from this equation. So I get something like this. Right? And that's the PVGO equation, either this or this, both. That's the PVGO equation for PE. So you can see this 1 over K into 1 plus PVGO over no growth company's valuation. 1 over K into 1 plus PVGO over no growth company's valuation. Value of the no growth company. So as a percentage of the no growth company, how much is PVGO? Plus 1. So that's just another way of analyzing. If you were given to analyze how it is impacted by PVGO, you would use this equation to figure out how P's are impacted by PVGO. So you can write that equation because it's not in your notes. Yeah. So that finishes the dividend discount part. Now we move on to the relative valuation part and hopefully the free cash flow part, right? So let's take a break. Let's come back at 10:30.